We often hear about markets going up and down, but what's been happening with gold lately? It's been genuinely head-turning.
It really has.
I mean, in just 9 trading sessions, the global price has apparently jumped by a massive 14%. Is this just like a fleeting moment, or is something bigger going on?
Well, yeah, that's the question, isn't it? A 14% surge in that short a time frame for gold. That's definitely noteworthy. It suggests some significant forces are at play.
Absolutely. And to get a real-time feel for it, we've been looking at excerpts from a YouTube video. It's by Lê Văn Teng, titled Javang Tang Quang Tang Jadan 14% Trong 9 Phien Quan An.
Right, so his immediate reactions to this market, craziness, you could say.
Exactly. So our mission here is to unpack why this rapid increase is happening, what the potential ripple effects are, and, crucially, what it might mean for you listening.
Okay, let's dive in.
All right, so this unprecedented jump. The YouTuber himself, he uses words like crazy and extremely unusual.
Yeah, which really highlights how unexpected this rally has been for many.
Totally. He mentions an immediate price jump of $63
Yeah.
and a 1.9% increase within a really short period on the day he was recording.
Wow, 1.9% in a day for gold. That indicates very strong buying pressure, real momentum behind this.
And get this, there's a significant gap he talks about between the international price and the domestic price in Vietnam.
Oh, interesting.
Initially, it was around 11 gia, which he clarifies is about 11 million Vietnamese dong per lung, and that lung is a Vietnamese weight unit, roughly 1.2 troy ounces.
Okay, got it.
And he notes this difference is fluctuating, even getting wider sometimes. It makes you wonder, what's causing that local divergence.
Yeah, a big divergence like that, it strongly suggests there are local factors involved, right? Specific to the Vietnamese market.
Like what, maybe?
Could be anything from local supply and demand, maybe currency fluctuations against the dollar, or perhaps even specific government policies affecting gold trade there that aren't hitting global prices the same way.
Right, right. He also points out just how fast it climbed within the trading day itself. He's throwing out figures like 3390, 3391, then bam, 3402, presumably USD per ounce.
Paints a picture of a really volatile session.
Definitely. And interestingly, the domestic gold price, SJC specifically, didn't immediately follow suit. It stayed at 118 million VND per lu at first.
A lag.
Yeah, but then later he mentions a Ngok Them gold shop quoting 122 million. So it looks like the domestic market is starting to react, just maybe not perfectly in sync.
While that lag often happens, it takes time for international prices to filter through local supply chains. You add import costs. Retailers have their own pricing strategies based on inventory risk.
Okay, that makes sense. And the different quotes just show it's not always a uniform domestic price either.
Exactly, not perfectly synchronized.
So let's pull back a bit. He gives some historical context, which is quite revealing. He compares this current rally to past increases, noting this 14.4% jump over these 9 sessions.
Which is already quite high.
Yeah, and he compares it to a previous 9-session rally that had a 12% gain. So it really emphasizes how exceptionally strong this current surge feels.
That kind of comparison is crucial, isn't it? It helps you see this isn't just a minor blip. It's, statistically speaking, a significant move compared to recent history.
But here's where it gets really interesting. He also mentions an impressive 42% increase in gold over the past year.
Wow, 42%.
Yeah, from April of the previous year up to when he recorded. That's a huge year-on-year gain. It shows this isn't just some flash in the pan.
No, definitely not. A 42% rise over a year points to a really sustained, powerful uptrend. It's likely fueled by a mix of things, maybe inflation worries, geopolitical uncertainty, perhaps a longer-term shift in how investors see gold as a safe haven.
Yeah, could be all that. Okay, so then he shifts gears a bit into technical analysis. He focuses on this cup and handle pattern.
Yeah, yes, the classic cup and handle.
Now, for listeners maybe not glued to charts all day, this is basically a way analysts look at price movements to guess what might happen next. Right?
Heard of, yeah.
Like, you see a dip and recovery making a cup shape. Then a little handle forms. Like the market's catching its breath before maybe jumping higher.
That's a decent analogy. It's generally seen as a bullish continuation pattern, so it suggests an existing uptrend might resume after this consolidation period.
Okay, so what are the key parts?
Well, you have the rounded cup, that's the price decline, and then recovery back to the previous high. Usually takes, say, 3 to 6 months, typically.
Right.
Then you get the handle, which is a smaller sort of downward sloping or sideways drift in price that comes just before the price hopefully breaks out higher.
Right. And the YouTuber points out something interesting here. He says the typical cup forms over 3-6 months, but the one he's seeing now seems to have developed over 5 years.
5 years. Wow, that is a long time for this pattern.
Yeah. He says it adds a layer of uncertainty. Does that long duration, does it change how you'd interpret it?
Well, it could, yeah. An extended cup like that, as he notes, might imply a really significant long-term shift in sentiment, a more robust base, perhaps, being built.
Good.
But it also means there's been more time for other factors to creep in and potentially disrupt or even invalidate the pattern. So yeah, uncertainty is fair.
He mentions the textbook stuff too.
Yeah.
Needs a preceding uptrend of maybe 30%. The cup depth should be decent, at least 30%, and the handle is shallower. And he feels the current price action fits this.
Okay.
So the big question, the price target. He says the pattern suggests taking the height of the cup and adding it to the breakout point. And he mentions a potential target of 3,800 USD per ounce.
3,800, that's quite a jump from current levels.
Yeah, he cites a textbook 88% projection based on the cup's depth.
Okay, that 88% projection gives an idea of the potential scale if the pattern plays out classically. But, and this is crucial, these technical targets are not guarantees.
Right, just possibilities.
Exactly. Potential scenarios, not predictions set in stone.
And it's interesting, he even mentions he initially thought a lower target based on maybe a 58% cup height might have already been hit. But now he's leaning towards that higher 3,800.
Yeah, and that shows you how technical analysis works in practice. It's not static, it's a framework, and you have to keep assessing, maybe adjusting your interpretation as the market actually moves.
There's not a crystal ball then.
It's definitely not.
Okay, another really important piece he talks about is trading volume. Why is volume so key when looking at price trends? Like, does it confirm the move?
Yeah, essentially. Think of it like crowd enthusiasm.
Yeah.
Volume reflects the degree of participation, the strength of conviction behind a price move.
Okay.
In a healthy, sustainable uptrend, what you want to see is prices going up and trading volume also increasing.
Right, more people getting involved.
Exactly. It's just growing conviction, lends credibility to the rally.
So the YouTuber emphasizes this. High and rising volume supports the idea that the trend might continue, right?
Mhm.
Whereas rising prices on low volume, that's a warning sign.
It can be, yeah. It suggests maybe there isn't strong, broad support for that higher price. Could mean a higher risk of the price reversing or correcting.
So you got to look at both the price and the activity behind it.
Precisely. And for example, if you see a breakout from that handle we talked about, if it happens on high volume, that's generally seen as a much stronger confirmation than if it breaks out on really light volume.
Gotcha. Okay, now to get a real feel for the human side of this, he shares some comments from the live chat during his stream.
Ah, the live reactions, always revealing.
Totally. You see disbelief at how fast prices are shooting up.
Yeah.
People regretting selling their gold too
Oh,
early.
playing classic hindsight pain.
Exactly. And then frustration from people trying to buy in now, feeling like they missed the boat.
Very typical emotional responses during big market moves. That fear of missing out, FOMO, can be powerful. And regret, that can lead to bad decisions too.
Yeah. There are also questions about, like, will the government step in? Lots talk about where prices might go. Some people echoing that 3,800 target by year end.
Interesting.
And people are comparing it to past gold bull runs like that 2001 to 2011 period. Plus, just sharing personal stories of buying and selling. It really shows how much interest and maybe anxiety these moves stir up.
Comparing to past cycles is natural. We try to find patterns. But it's so important to remember, like, every market cycle is unique. Different economic backdrop, different geopolitics. History offers clues, but it doesn't just repeat exactly.
Good point. Then he shares this really relatable story. A listener reached out. They were supposed to buy gold for their parents, entrusted with the money.
Oh, dear.
But instead, they decided to invest it in stocks, which then went down. Meanwhile, gold, as we know.
Took off. Ouch, that's a tough spot to be in.
Yeah, and it really highlights, like you said, the risks of trying to time the market, maybe chasing higher returns when the original plan was different.
Absolutely, especially when it's not your money.
So the YouTuber's advice for this person, and really for anyone needing to buy gold when prices feel high and volatile, is pretty practical.
Okay, what does he suggest?
First, acknowledge the responsibility, right? The need is to buy for the long term here. But instead of buying it all at once, he suggests dollar cost averaging.
DCA. Sensible approach.
Yeah, basically buying smaller amounts regularly, like maybe That's a fraction of the loot we mentioned, maybe every week or every couple of weeks.
Yeah, that's a very sound strategy, especially with volatile assets like gold can be. You spread your purchases out, reduce the risk of putting all your money in right at a peak price. You average out your cost.
Take some of the emotion out of it, maybe.
Exactly. It helps manage that fear of buying high, makes it less about timing perfectly, which is nearly impossible anyway.
He really stresses that, short-term moves are just so hard to predict. So this gradual approach helps mitigate that buying at the absolute top fear.
It's a risk management technique, pure and simple, makes investing more manageable, especially if you're nervous about entering a market that feels elevated.
Okay, now he also talks about thinking in different time frames for gold investing, like long term, say 10 years plus.
Right, the traditional view.
That really fits with the buy and hold idea, like the advice for the listener needing gold for their parents.
Yes, gold has historically been seen as that long-term store of value, a hedge against inflation, uncertainty. Over a decade or more, the short-term ups and downs tend to smooth out somewhat.
Then there's the medium term, maybe 3 to 5 years. Here he brings up the idea of gold price cycles, roughly 10-year cycles, he says, but with variations.
Ah, the cyclical view.
Yeah, he even mentions shorter cycles around 10 years, medium ones around 30, and really long ones, 90, 100 years plus or minus. He suggests this current rally, maybe starting 2018 or 2022. It could be in the later stages for someone with that medium-term outlook.
Understanding those potential cycles can provide a framework, but again, they aren't clockwork, are they? Global events can completely throw off historical tendencies.
True. Then there's the short-term view, looking at just, say, the end of this year. This is driven more by wanting quick profits, right?
Yes, much more speculative.
And he's clear. Much higher risk. Requires faster decisions. Buy quickly. Sell slowly, he says. He uses that potential 11% gain to the 3,800 target as an example, but immediately warns there's similar downside risk.
Absolutely. Short-term trading in gold, or anything really, demands active management, knowing your risk tolerance inside out, and having a clear exit plan. The potential for quick gains always comes with the potential for quick losses.
Definitely sounds like a different game.
Yeah.
He also tackles something interesting. Relying on news to predict prices.
Ah, yes. The news cycle trap.
He says constantly checking news might not be the best strategy, and he brings up that old market saying, buy on rumor, sell on news.
A classic for a reason.
The point is, by the time news is widely reported, especially after translation and all that, the information is often already baked into the price.
That's a critical point. Markets are pretty efficient, especially with public information. The sophisticated investors, the institutions, they often have faster access to data and analysis and have already acted by the time it hits the headlines.
He uses a great example. A stock has amazing earnings results announced. Sometimes the price peaks right then because everyone who anticipated it already bought in.
Exactly. The news release confirms what the market already suspected or knew.
And he talks about the time lag, too. Like a hypothetical report about Ukraine might take days to get approved, published. By then, it's ancient history for trading purposes.
The speed of info is incredible now, but there are still layers. Big players often have real-time feeds, proprietary analysis, things individual investors just don't see immediately.
So his advice is basically, don't rely mainly on news headlines for short-term predictions. The big players are usually way ahead.
Yeah, trying to trade purely off public news is often being reactive, not proactive. Better to understand the underlying drivers and stick to your own strategy.
Which brings it all back to his final, really important point.
Yeah.
Whether you should buy or sell gold. It depends entirely on your personal situation.
Absolutely fundamental.
Your goals,
Mm-hmm.
how long you plan to invest, how much risk you can stomach. He's very clear. His role is sharing info, different perspective, not giving personal financial advice.
And that's crucial. Every investment decision has to be tailored. What works for one person might be totally wrong for another based on their circumstances, their risk tolerance. You have to know yourself.
So, okay, let's try and sum up this deep dive. We've looked at this crazy fast climb in global gold prices. We touched on potential reasons, market sentiment, technical patterns like that big cup and handle.
Right, and the importance of checking trading volume to see if there's real conviction behind the move.
Yeah, exactly. We heard about the wide range of reactions from people watching this unfold, the fear, the regret, the speculation.
And the different strategies depending on whether you're thinking long-term, medium-term, or just trying for a short-term gain.
Plus that caution about relying too much on news for quick predictions and the focus on market cycles and ultimately your own situation.
It really highlights how complex the gold market is, doesn't it? Technicals, sentiment, global events, individual needs. It all plays a part.
Definitely. And that leads us nicely into our final thought for you, the listener, to mull over. Given everything we've discussed, these historical cycles, the current global uncertainties, what unexpected factors, what curveballs might pop up in the next few years, things that could really shake up the price of gold, maybe extend these cycles, or perhaps disrupt them completely.
That's a great question to ponder. What are the unknown unknowns out there?
Exactly. Something to think about as you navigate the financial world.